Good evening, everybody. Thanks for carving the time out of your busy schedules to spend a few minutes with me this evening. Tonight, we're going to be covering a few year-end tax strategies for your financial success. So let's dive in. Introduce myself quickly. My name is Doug Kuring. I'm a certified financial planner at a firm called Wealth Enhancement. I run the Kuring team in the Danbury, Connecticut office. We specialize in integrated retirement planning, tax, estate strategies, risk management. I've been featured in a couple of prominent media outlets. And once upon a time, I graduated from Fairfield University with a degree in finance. Feels like eons ago. So in my line of work, we often encounter the belief from clients that tax planning really only makes sense if your income has increased significantly over the past year. And that's certainly one reason to revisit your tax plan. After all, for high income earners, year-end tax planning is an ideal way to help reduce your tax liabilities and ultimately minimize your tax bill for the year. But year-end tax planning is also important if your income has gone down. If that's the case for you, strategic planning can help you mitigate your losses so you can preserve your savings and potentially take advantage of your lower income to rebalance your portfolio. Either way, getting into the habit of reviewing your tax situation each year at the end of the year is a great way to enhance financial success as your earnings shift over time. That's why we like to cover really a couple of different tax optimization strategies this evening, which you'd want to consider based on whether your income was higher or lower than expected. So really the presentation will be broken up into two sections: strategies if your income is higher than normal, and then strategies if your income is lower than normal. But let's take a moment really quick to review the basics. So tax planning for individuals and families within our firm, it generally starts with proactively trying to identify and lay out all of the various income sources and life events, whether it be selling a business, selling a piece of real estate, or selling an investment in their portfolio, whatever it may be. We're trying to lay all of those out and trying to expect what the timeline is for those occurring, whether it's going to be this year, next year, many years down the line, and really developing a timeline. Now, my team and I draw these taxable events out by asking questions like, do you expect to retire next year? When do you anticipate selling your home and downsizing? Are you moving to a new state in retirement? How much and when do you anticipate you'll sell your business or you'll sell stock in Apple? If, for example, you had a very concentrated position in Apple, a lot of clients do. Those are just a couple of examples of questions that we use to draw out a really well-designed and thoughtful tax plan. So understanding your tax bracket, which is the income range that determines the percentage of income you'll owe in taxes, it's super important. And this range varies depending on whether you'll file your taxes as a single filer, married filing jointly with your spouse, head of household. There's a variety of different tax filing statuses, and then it also depends on the income level for that year. So here on this slide are the federal income tax brackets for this year, 2025. And as you can see, for single filers, the lowest tax bracket is 10% on incomes under $12,000, while the highest tax bracket increases from 10% up to 37% on incomes over $626,000. For married couples filing jointly, the 10% tax bracket applies to incomes under $24,000, roughly double the single. And then while the 37% bracket applies to incomes over $751,000. These percentages make a huge difference when it comes to calculating your annual tax bill. And ultimately, they explain why tax bracket planning and management are so important and why it's critical to review your tax plan each year, particularly if your income situation is going to change. Now, after we've estimated where a household will land from a tax bracket perspective, the next question that so many of our clients and prospective clients ask is, okay, well, how much room do I have before my tax situation changes, before I potentially go into a higher tax bracket or phase myself out of a potentially valuable tax deduction? Now, we've coined this as a client's income tax capacity, and it answers a series of really important questions when it comes to developing and implementing tax strategy, such as how much room do I have before my tax situation gets better or worse? Can I implement a certain tax strategy that saves me a significant amount of income tax? Or is now a good time to move forward with a certain transaction or life event? Or is there a better time in the future to do that based on my income sources? You'll see a hypothetical example of a married couple filing jointly in 2025 here on this page. This is an income tax map, and it includes the various deductions, income phase outs, and income capacity that they have before they wind up triggering key tax thresholds. Basically, this map lays out for every incremental dollar of ordinary income that I add to my tax return, what does that do to my tax situation? This range calculation, right, is basically what it is very powerful when it comes to strategies like Roth conversion planning, taxable account rebalancing, and even as simple as just raising money to support one's lifestyle expenses. I've never run into a situation in my professional career where understanding the tax impact of a financial decision ahead of time wasn't a smart move. So it's important you commit to going through this process. So let's starting with income strategies in the year where your income is higher than normal. If you find yourself in a higher tax bracket for this year, really any year, one of the best ways to reduce the taxes you'll owe is by maximizing contributions to your tax-deferred accounts, such as a traditional IRA, 401k, employer savings plan. This has a range of benefits. First, contributions to these retirement accounts aren't taxed, and the amount you contribute is deducted from your taxable income. You may be able to lower your taxable income sufficiently to fall into lower tax brackets, right? As an added benefit, maximizing your contributions can put you on, obviously, more solid footing for retirement. Although you'll pay tax on the money when you withdraw it in retirement or when your required minimum distributions begin, chances are you'll be in a lower tax bracket by that point. You know, if you're retired, you no longer have that employment income hitting your tax return. So rather than paying tax on that income today while you're in a high tax bracket, you can defer your taxes to a later year when you're likely in a low tax bracket. As you can see from this chart, each type of employer savings account has a different annual contribution limit. Additionally, if you're over 50 years old, you may be able to make catch-up contributions, which would further reduce your tax bill for that year. And if you're over 60, you may also be able to make super catch-up contributions. This is a new provision that came into force recently. So the best way to proceed here is always, work with your financial professional. Okay, for those of you who are clients of our firm, that would be me and my team, to assess the contribution room available for you to make, and then across all your different accounts, and obviously determine how much you can comfortably contribute to that year, all the while knowing you've got a lifestyle that you have to support. Another way to reduce your taxable income before the end of the year is to conduct tax loss harvesting. This will obviously be very client specific. So some of you may have losses in certain investments in the year, some of you may not. But at a basic level, tax loss harvesting allows you to offset some of your realized capital gains with realized capital losses. For instance, if you've sold investments at a loss, you can use those losses to reduce the capital gains tax you would otherwise owe on investments you sold for profit. All right. Even if you didn't realize any capital gains this year, you can still use the benefits of a tax loss to offset up to $3,000 of your ordinary income. That's a deduction that flows through onto your tax return. You can also carry forward any investment losses you realize this year to offset gains in the future. So this is partly what makes tax loss harvesting a good long-term strategy for high income earners and in general, really for anybody, okay? The third strategy, if your income this year is higher than normal, involves taking steps to accelerate your available tax deductions. Now, as a taxpayer, you have a wide range of deductions that are available to you, but today we're going to focus on 4 really underutilized deductions that can help you reduce your taxable income during high earning years. The first is to contribute to a donor advised fund. Contributing to a DAF, donor advised fund, triggers an immediate tax deduction. It also allows you to direct the charity on how to spend your donation after the money has had time to grow in the fund. The second consideration is to prepay your state income or levied property taxes. If you plan to itemize your deductions, you may be able to prepay next year's taxes this year, which would make you eligible to deduct them from your current year income. Again, it's a strategy. Sometimes folks take advantage of it. I would say in most cases, this one is generally reserved for years and where we have very high income and we are searching desperately for deductions to offset it. The third idea is to optimize your charitable donations. For instance, you can donate appreciated assets to the charity of your choice rather than making a cash donation. So a lot of folks who have concentrated stock positions, they will donate shares of that concentrated stock, which reduces their concentration on the personal side and also accomplishes their goal of donating to charity. Finally, starting at age 70 and a half, you can route distributions from your retirement accounts, your RMDs, required minimum distributions, directly to a qualified charity, 501c3, using the strategy called a qualified charitable distribution, acronym QCD. This strategy can help retirees keep their income down, which can be particularly helpful, like I said, once your RMDs have begun, which, depending on the year you were born, is generally age 73, but can go up to age 75. Finally, you'll want to try to avoid the net investment income tax. If you're not sure what this is, you're not alone, but it is an additional 3.8% tax on investment earnings over your modified adjusted gross income threshold. Where we see the net investment income tax kick in most commonly is in the years where there's large amounts of stock sold in a non-qualified account. That would be a non-IRA account. And the taxpayer has a large amount of capital gains on their return. And all of that capital gains income counts toward this. And if you're over the thresholds, which you can see here on this page, you will pay an additional 3.8% on every dollar above these thresholds. Okay, let's head into a section here. We'll look at some tactics in the years where your income is lower than normal. So we'll be looking at 3 different strategies here: deferring your tax deductions, rebalancing your portfolio, and considering a Roth conversion. Roth conversions are a hot tax strategy. The first strategy is deferring your itemized tax deductions, okay? The idea here is simply to avoid taking tax deductions you don't need. When you file your taxes for the year, you're still going to claim your standard deductions. If your income is lower this year, however, it may make sense to push out any deductions you control until a later year when your income is higher so you can make them count. An example of that is maybe taking a year or a couple years off of making charitable contributions, but still eventually giving them in years where your income may pick up again. Just a simple example that may or may not fit your personal circumstances, but is certainly one to consider. The second strategy here is to consider during lower income years, end of year portfolio rebalancing. When we refer to a portfolio as balanced, what we're really actually referring to is the mix of different asset classes within that portfolio. Typically, that balance will reflect your personal investment goals, risk tolerance, etc. Sometimes, however, based on market performance, your portfolio can become skewed, resulting in an asset mix that doesn't match your risk tolerance. For example, we've had really a decade and a half of extremely strong above average returns from the stock market, particularly US large cap stocks. Many folks have concentrated positions in their non-qualified accounts as a result of that. And if they sold those positions, they would realize long-term or potentially short-term capital gains. And that tax consequence generally, from my experience, holds a lot of folks back from rebalancing and de-risking their portfolio. Now, rebalancing involves bringing your portfolio holdings back to their ideal ratio, which entails buying and selling some of your assets. If you sell during a high income year, however, the additional gains you earn could push you into a higher tax bracket and result in additional capital gains taxes. You see the tax brackets for long-term capital gains rates here on this page at the federal level. For this reason, low-income years present a good opportunity for portfolio rebalancing. We often refer to intentional portfolio rebalancing as tax gain harvesting in years where income is lower. What we're trying to do is have the gains on these positions realized in years where we can take advantage of potentially lower capital gains tax brackets. As you can see here, if you're a single filer whose income fell below $48,000 for this year, believe me, in today's world, that's difficult to accomplish. But if you're in that position, you can potentially sell some of your assets without owing any capital gains taxes at all. If you're married and filing jointly, you would still owe 0% capital gains tax if your income is under $96,000. Finally, it could be an optimal time in lower income years to consider a Roth conversion. Simply put, a Roth conversion involves transferring pre-tax retirement funds from a traditional IRA or 401k into a Roth IRA. One of the main advantages of holding funds in a Roth account is that you won't pay taxes when you finally withdraw the funds during retirement. Roth IRAs also do not have required minimum distribution requirements from the IRS, which allows you to control your income taxes much better in the future. On the flip side, a Roth conversion, it means you'll have to pay taxes today. You're prepaying taxes today when your income is lower for the benefit of not paying taxes later when your income may be higher. All right. So that's it on the Roth conversion. Here's a quick example of a Roth conversion to understand how this might work in practice. Let's say you typically earn $110,000 per year. You're a single tax filer. That puts you in the 24% federal marginal tax bracket. This year, however, let's say your income falls to $90,000. Maybe you switched over to a new job that doesn't quite pay as much just yet. Whatever the case may be, this lower income puts you now in the 22% tax bracket. In this instance, you could transfer over $10,000 from your traditional accounts, IRA accounts, into a Roth IRA account while still remaining in the 22% tax bracket. As you only start paying 24% tax on any income above that $103,000 or so threshold. So while Roth conversions can't help you with your tax bill today, they have the potential to greatly reduce your taxes in retirement. Once you allow those funds to grow tax-free and then withdraw them later in life, like I said, you're not paying taxes on them. There's lots of potential advantages of Roth conversions, there's no doubt. But this strategy is not right for everyone. It's generally best, take it from me, it's generally best to put together a multi-year Roth conversion plan prior to committing to make sure that performing a Roth conversion makes sense for you. Lastly, if you're going to increase the income on your tax return in a lower income year, remember, the higher your income goes, the more you may be in the crosshairs of Medicare surcharges, also known as IRMA. All right, IRMA is an acronym that stands for Income-Related Monthly Adjustment Amounts. Essentially, the more income you have on your tax return, the higher your Medicare premiums could go. Okay, if you are not careful and have not developed a well-designed plan to load income onto your tax return, you could very well end up regretting adding all of that income at the end of the year. So that's just a thought on sort of like a beware notice on loading income onto your return. So we covered a lot of ground, but to be honest with you, we really only scratched the surface. There's so much opportunity, thinking, and planning that needs to go on here. With that said, I hope I've given you some new things to think about in terms of year-end tax planning and how to consider taxes as you efficiently structure your finances and investments in both higher income and lower income years. We have a few key takeaways here on the page, but in my opinion, number 3 is by far the most important. You've got to work with a professional proficient and experienced enough to help you create a tax plan before you make any important financial decision that might be potentially irreversible. The IRS doesn't do do-overs, so you've got to get it right the first time. If you'd like to delve deeper into any of these topics, please don't hesitate to reach out. You can also visit our team page by searching the Kuring team on wealthenhancement.com. I also send out a weekly client newsletter. And if you would like to inquire about subscribing to that newsletter, there's absolutely no solicitation that goes on via that weekly newsletter. It has more content related to taxes, financial planning, investments, etc., that we spend a lot of time writing about and investing in on behalf of our clients and prospective clients. Please reach out to us if you'd like to subscribe. We'd be happy to get you on the newsletter. With that said, thank you, and I hope you enjoyed this evening's presentation. Take care.